Fiverr and Upwork are two very interesting gig economy platforms that are under threat right now because of the rising effectiveness of artificial intelligence. Investors are speculating that why would entrepreneurs go to these platforms when they could just use AI to complete the tasks that they would hire somebody on these platforms to complete? And that has these stocks trading at relatively cheap valuations. But investors trying to decide between these two are asking me which one is the better buy, Fiverr or Upwork. And in this video, I'll answer that question. I'll compare these two on revenue growth, on operating profit margins, and return on invested capital. And I'll also share with you my proprietary discounted cash flow valuations for these companies to calculate a fair value for their stock prices. And then I'll answer that question of which one I think makes the better investment today for long-term investors. Let's take a look.
I want to thank The Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
All right, so Fiverr and Upwork have done a great job increasing their revenue since 2017, where Upwork started with $202 million in trailing 12-month revenue and increased that by more than 3x to $773 million. Similarly, but more explosively, Fiverr has increased its revenue, I should say, from $52 million in 2017 to $419 million, good for a compounded annual growth rate of 32%. Fueling the growth in these two companies are several tailwinds from both sides of the supply and demand equation. Entrepreneurs, business owners, and other smaller businesses look to these companies as a way to get people into their company to complete tasks in a more convenient manner than hiring somebody full-time. It's also a lower risk way to add labor to your workforce. Where you hire people on Upwork and Fiverr, you hire them for specific tasks that need to be completed. So you're matching a job with a person. Whereas when you bring somebody on board your company full time, you're agreeing to pay them a fixed amount of money without necessarily knowing for sure if there's going to be work available for them to complete. So it's a more risky way to bring people on board. Also, you don't want to be hiring and firing people as your business increases and decreases in size. Hiring people on the gig economy platform allows a business flexibility before going out and making a more permanent decision to bring somebody on board full time. On the other side of the equation, the supply side, the gig economy offers workers a flexible arrangement to work whenever they want to, for whomever they want to, for however long they want to, without agreeing to show up at a set place at a set time for a certain amount of days every week and every month and all year long. You don't have to show up Monday through Friday, 8 a.m. to 5 p.m., regardless of whether you feel good or you have something else going on, or whether you just want to take a day off to go to the beach. You can't really do that if you're working full time for a company. You have to go and ask permission, which may or may not be granted. And that doesn't feel very good to have to go out and ask permission for what you can do with your time. So that's attracted a lot of workers to these platforms who like that flexibility. And I expect that will continue, that search for more flexible working arrangement has attracted people to the gig economy, not just to Fiverr and Upwork, but other gig economy platforms like Uber, Lyft, Instacart, DoorDash, Grubhub, etc. People like those flexible arrangements. Not everyone. I understand it's not for everyone, but a lot of people are attracted to this type of working arrangement. The next thing I wanted to compare these companies on is their operating profit margins. And Upwork has experienced a nice surge in operating margins since 2017 from negative 1.5% to 16.1%. Fiverr has also improved significantly, but it's still negative at 2.1%, but that's improved from negative 37.5%. If you recall, there was a huge inflection point in the economy in 2022, and you can see that here with Fiverr and Upwork here. Upwork were experiencing declining margins until 2022, where the management team made huge changes to control costs, focus on profitability, and margins improved dramatically since then. Fiverr also made improvements, and since then they've continued on that trend. I like the competitiveness in the industry, or I should say, I like the competitive nature in the industry right now, where they are each and all increasing fees. They're all increasing the fees that they take on the platform. And that's another thing I like about these companies is they are platform based. They don't own any of the they don't pay any of the people on either side of the platform a fixed amount. Upwork and Fiverr just operate the platform, and they take a fee for every transaction on the platform. So every time somebody hires somebody on the platform for a job, Fiverr and Upwork take a percentage of that revenue that's earned. And in that way, they're an asset light business model, which allows them to grow at less with less friction. I like those business models. In fact, Uber I have rated as the best stock to buy right now, in part because of that platform business model. So the platform business model is one that I think is very attractive given the current market dynamics, and Upwork and Fiverr operate on those platforms. The next thing I wanted to compare these two companies on is the return on invested capital. And in this regard, they both have great potential and they've made great improvements over the previous several years. But Upwork is further along in this at a 45% return on invested capital, ROIC, compared to negative 2.2% for Fiverr. Still, Fiverr has made great improvements from negative 42%, but Upwork is further along in this transition. And Upwork also works with larger businesses looking to hire people on larger scale instead of one person for one job. Upwork works with some companies that look to hire 10 people for 10 jobs or 100 people for 100 jobs, even if it might be a temporary non-full-time gig. So now that we looked at the important financial metrics and compared them, let's look at valuation. And what you're looking at now is my proprietary discounted cash flow valuation, where I calculated a fair value for Fiverr stock to be $54 a share. The current market price is just $22 a share. And noticeably, as Fiverr's market cap has fallen, a larger percentage of its capitalization is made up of its debt at $457 million, giving the company a lower weighted average cost of capital at 9.93%. Meanwhile, Upwork, I calculated its intrinsic value per share at $21 compared to the market price of $14, and its weighted average cost of capital is noticeably higher at 11.74%. And the largest reason for that is because a smaller percentage of its capitalization is made up of debt. And across the board, debt is usually a lower cost of capital. And so if your capital structure has a larger percentage of debt, it lowers your weighted average cost of capital. Not infinitely, but to a certain extent, right? And the reason for that is, number one, because debt is tax deductible, your interest expense is tax deductible. But number two, if you borrow too much, the risk of bankruptcy or the risk of default raises your cost of debt exponentially. So you can't continue borrowing and lowering your weighted average cost of capital, but you can optimize your weighted average cost of capital by balancing the debt to equity mix. Right now, the debt to equity mix is favoring Fiverr in its capital structure to lower its weighted average cost of capital. Regardless, according to my DCF model, they both look undervalued. Now, when I look at valuation on a forward price to earnings basis, they also look undervalued. Upwork is trading at a forward price to earnings of 10.8, while Fiverr is trading at a forward price to earnings of 8.3. Ridiculously cheap valuations, in my opinion, when you're looking at a business with these characteristics of historical performance. But the reason why these stocks are trading at cheap valuations is what we see looking ahead. The risks from artificial intelligence are meaningful, and that's what's bringing down valuations for Fiverr and Upwork. Investors are concerned that more and more businesses and entrepreneurs are going to look to AI to have these tasks completed instead of going to Fiverr or Upwork to have these tasks completed. And I think those risks are overblown. The management teams at Fiverr and Upwork have repeatedly stated that as many jobs as artificial intelligence is removing from the platform, it's adding on the other side of the platform. It's adding jobs related to artificial intelligence on the platform, and some jobs are being removed because of artificial intelligence on the platform. But on net, the companies have reported that artificial intelligence is still a slight positive for the company in terms of total amount of jobs on the platform and businesses looking for jobs on the platform. But what's significantly negative is the risks. The risks have been major, and you can see the valuations declining for these two companies because of the risks. Now, I like these two. I have them both rated as a buy, but if I had to pick just one of them to buy today, I think the outperformance of Upwork stands out on its margins, on the improvements of its margins and its relationships with larger businesses. I have Upwork at a slight advantage over Fiverr because of those factors. In fact, I would say more than a slight advantage. I think Upwork has proven over the last couple of years as the better gig economy platform here. So if I had to pick between these two right now today, I would pick Upwork as the better stock to buy.
Hey everyone, I'm excited to announce that my book, Make Money Buying and Selling Stocks, a 6-step framework for evaluating publicly traded companies, is finally available for sale. Unlock the power of intelligent investing with my 6-step investing framework. It's a proven system designed by a university professor and a chartered financial analyst. Frustrated by the lack of frameworks that met my needs and high standards, I developed this comprehensive guide to help investors at all levels make confident and informed decisions. In this book, you learn how to assess opportunities, manage risk, and build a portfolio that works for you. No investor should dive into the market without a solid strategy, and this step-by-step framework provides you the roadmap you need. Whether you're just starting out or looking to refine your approach, this guide will empower you to take control of your financial future. I've added the link in the description below.